everyone. In this series, we'll be talking about the DOM, or Depth of Market Chart. You may also hear it referred to as the order book or informally as the ladder. For today's lesson, we're going to dive into what exactly the DOM is, how we like to read the information it provides, and some ways we like to interpret it as well. These concepts will allow us to have a shared vocabulary and understanding of the fundamentals, and will serve as a foundation for future lessons where we will review interesting moments in the market through the lens of the DOM. Before we go any further, I do want to emphasize that the DOM is not a magic bullet to your trading woes. In fact, it is far from it. At least 80% of the work has already taken place before the market even opens. Since we do a lot of preparation beforehand by analyzing market structure to help us develop a game plan as we come into the session. If you want to learn more about these ideas, check out our Intro to Market Profile seminar and our educational sessions. Instead, the DOM helps us refine our execution edge so that we can be as precise as possible and manage our risk proficiently. Our plan coming into the session is our hypothesis for what may happen that day, but the DOM provides real-time confirmation of that hypothesis, giving us more confidence to move forward. All that being said, the reason I really like the DOM is because it is the market. When other people talk about a financial instrument, they are often referring to some sort of chart. On the other hand, the DOM gives us a peek into what's happening behind the scenes of that chart, which is the buyers and sellers interacting to find a fair price. That is, by definition, the core of any market. Before we dive in, I want to share the following disclaimer. Any Trade with Titans content, including this video, should be never interpreted as a recommendation to buy or sell any securities. Trading is risky and can and often will result in financial losses. This video and all other Trade with Titans content is purely for educational purposes only. Please see our terms of service on our website, tradewithtitans.com, for more information. Now, on to the lesson. Here's an example of a mock DOM we put together for a sample asset like a futures contract. You can see there are 4 columns: price, bid size, bid vol, ask vol, and ask size. Price should be self-explanatory, and we'll go over all of the others shortly. When you want to buy or sell an exchange-traded security, there are 2 fundamental types of orders. The first is called a limit order. A limit order is an instruction to purchase an amount at a set maximum acceptable share purchase price or to sell an amount at a set minimum acceptable sale price. The order is processed only if the asset trades that price. When you place a limit order, you're guaranteed to have that order execute at your pre-specified price or better. We often refer to buyers or sellers who place limit orders as passive, because by placing a limit order, they're indicating that getting their desired price is more important than having their order filled immediately. Or in other words, they're willing to wait to get what they want. Limit orders show up on the DOM under the bid size or ask size columns. The bid size shows buy limit orders, and the ask size column shows sell limit orders. In this case, you can see that there are 6 limit orders to buy at a price of 99, 4 at 98, 5 at 97, 3 at 96, and 2 at 95. These could all be from the same trader or a combination of different traders. Similarly, there are 6 limit orders to sell at a price of 100, 10 at 101, and so on. The values in the bid size or ask size columns help us form a better understanding of liquidity in the market. If there are not many limit orders to buy or sell, we say liquidity is low, or the order book is thin. Such a phenomenon can also indicate that volatility is high. On the contrary, lots of limit orders means that there's lots of liquidity, or the order book is thick. From here, we can also derive the idea of best bid and best offer. This represents the highest bid and lowest offer currently available. These prices are usually quoted by the exchange and shown to traders. The difference between the best bid and best offer is called the spread. What happens if there's nobody placing limit orders at a given point in time? For example, if there's a crisis happening and people are scared to trade, or if we want to buy a rarely traded option on a small market cap stock. What do? This problem is why we have market makers. Market makers are institutions whose job is to provide a bid and offer for different assets based on what they believe is a fair price. Their reward for providing this liquidity is collecting the spread along with any rebates from the exchange. A little fun fact, during the Black Monday crash of 1987, some market makers got spooked and decided they wanted to stop providing liquidity, which caused even more volatility in the market. In fact, Madoff Securities, run by the infamous Bernie Madoff, was recognized as one of the honorable market makers that abided by their mandate and continued to fill orders, even though they knew it would likely be at a loss to them. Why are there no limit buy orders at a price of 100 or limit sell orders at a price of 99? Good question. Say there were 7 limit buy orders at a price of 100. The exchange would match 6 of these orders against the 6 limit sell orders at the $100 price, causing the best bid to become 100 and the best offer to become 101. We'll go into this idea in more detail shortly, but the idea is that there will always be a spread in the market, even if it is narrow. There are some downsides to limit orders. While limit orders provide a great picture of liquidity, they are available for everyone to see. Meaning that if I want to buy another 10 contracts of this instrument at a price of 100 and I place my limit buy order, the DOM will update to show everyone that 10 more orders came through. Sometimes this information can cause adverse traders to believe that there is increasing demand for the security, and they may replace their limit sell orders to be at a higher price as a result. We often refer to this occurrence as price running away from you. Additionally, limit orders can be changed by the trader who placed them at any time before they are executed. So when we see the bid size and ask size columns on the DOM, there is no guarantee that those orders will be there in the future, especially when price moves closer to them. This flexibility, combined with the previous point about limit orders causing adverse reactions, often leads to what we call spoofing, or traders placing limit orders at prices away from the current best bidder offer with no intention of ever having them executed. This practice is illegal, but it does take place. Here's another short story for you. There was a very well-known order flow trader in the mid to late 2000s called Nav Sarao, who quietly traded S&P futures in his parents' home in the United Kingdom. In fact, he pioneered many of the order flow concepts that we use today. After getting frustrated with more spoofing occurring due to the rise of electronic trading, he decided to take matters into his own hands. He developed an algorithm to spoof orders very aggressively, so if he wanted to buy, he would place a lot of large limit sell orders. Other traders would see them and believe that a large seller had stepped into the market and either cancel their limit buy orders or start selling themselves, driving price lower. Then, he would end up buying at this lower price and cancel those large limit sell orders. With those limit orders gone, price would return back to where it was before, allowing him to sell for a nice profit. This trick made him millions, until one day he spoofed the market a little too aggressively, causing the infamous flash crash of 2010. The US government investigated and found him guilty of spoofing and sent him to prison. Although spoofing is illegal, because it is very hard to prove and often not enforced, it is quite common. Furthermore, as limit orders are public information, many traders try to hide their true intentions in creative ways, which we will discuss in future videos. Thus, we often don't place a lot of emphasis on the bid and ask size columns. Market orders are the counterpart to limit orders. They are instructions to purchase or sell an amount immediately at the best available bid or ask, meaning that the order will execute right away, but without a guarantee of the price. We often refer to traders who place market orders as aggressive, because by placing a market order, they are indicating that getting an optimal price is not as important as having their order filled immediately, or in other words, they're unwilling to wait. In contrast to limit orders, market orders take liquidity from the market. In fact, analogous to the rebates offered to makers, some exchanges have additional fees associated with market orders for this very reason. Let's now see how patient and aggressive buyers or sellers interact as a part of the market auction process. To simplify things, let's take our mock security and imagine there are 5 traders currently in the market. You can see their limit orders reflected on the DOM. The limit orders were placed in the following sequence. Trader 1 wants to sell 10 contracts at 100, so he places a sell limit order for 10 contracts at 100 at 10:01 a.m. Trader 2 wants to sell 5 contracts at 100, so she places a sell limit order for 5 contracts at 100 at 10:04 a.m. Trader 3 wants to sell 6 contracts at 101, so he places a sell limit order for 6 contracts at 101 at 10:02 a.m. Trader 4 wants to buy 1 contract at 99, so he places a buy limit order for 1 contract at 99 at 10 a.m. Trader 5 wants to buy 4 contracts at 98, so she places a buy limit order for 4 contracts at 98 at 9:55 a.m. Recall that we consider traders 1, 2, and 3 passive sellers, and traders 4 and 5 as passive buyers. The best bid is now 99 and the best offer is 100. The market stays here as there are no limit orders that we can match together. Now, an aggressive buyer enters the market and places a market buy order for 5 contracts. This order is matched against the limit sell orders for 10 total contracts at the best offer of $100. We say both the market and limit order are filled. The best bid remains at 99 and the best offer is still 100, but the ask size goes down from 10 to 5. You can see that the DOM has updated accordingly. Additionally, note that the ask volume column is now updated to reflect this recent transaction of 5. We can interpret this as the 5 market buy orders or 5 limit sell orders were executed at this price. You might also be wondering whose order got filled, Trader 1 or Trader 2, or some of each. Good question. Because we said that Trader 1 placed his orders first, he was first in the queue. As such, his limit order was partially executed, and Trader 2's limit order still remains as is. The values on the bid and ask vol columns will grow as additional orders are executed at the current best bid or offer. However, new orders are executed at different prices. Sometimes the bid and ask vol values for recently executed orders will either reset to 0 or stay the same. If they remain the same, when a future trade is executed at that price, they may either time out and reset to 0 or continue to grow. This behavior is dependent on your data provider and how the settings for your DOM are configured. Feel free to change it based on your preference. For S&P and NASDAQ futures, we like to have our bid and ask vol completely reset at the start of the RTH market open at 9:30 a.m. Eastern, and either after the market closes at 4 p.m. Eastern or after the CME maintenance period ends at 6 p.m. Eastern. We prefer to have the bid and ask vol timeout setting to be 2500 milliseconds, meaning that if price returns to an older price that already had corresponding values for the bid and or ask volume columns, any additional orders currently executed there will aggregate on top of those prior values if no more than 2500 milliseconds has elapsed. Or in other words, the values in the column will continue to increase from when they left off as long as the most recent order happened within 2500 milliseconds of the one that's currently being executed. Otherwise, the values for bid or ask vol will reset to 0 first and then start being filled in. We like this setting because it allows us to keep track of current market activity accurately, but also not be biased by old and possibly irrelevant orders. The bid and ask vol columns are the only columns we primarily pay attention to when reading the DOM, since these columns only change when actual orders get executed, unlike the bid and ask size columns. Those represent potential future orders and are prone to spoofing. However, the bid and ask vol columns show us true market activity. It is more meaningful if 500 contracts are executed at a price versus a new limit order being placed to buy or sell 500 contracts at that price. That's why you might hear us say that we do not care about resting orders, which are the unfilled limit orders we see on the DOM. Sometimes, misguided traders look at resting orders and believe that because the market is liquidity seeking, it will gravitate towards large unfilled limit orders. However, we already went over why that reasoning might not be correct. Firstly, those orders may be the product of spoofing, and second, market participants may run away from these large orders. But even if we accept the premise behind this idea, there's still a big flaw. These large resting orders on an instrument like the S&P futures are usually for a few hundred or few thousand contracts, let's say roughly 50 points away from the current price. However, if the goal of market participants is to grab that liquidity, then they would have to place several thousand contracts worth of market orders to move price by 50 points. Does it really make sense for someone to waste so much money and effort for an insignificant reward by comparison? Absolutely not. You might be asking, if we only care about executed orders, why bother with the DOM and not just use the tape, or time in sales, which shows the sequence of executed orders? While we do use the tape, we feel the DOM is a more powerful tool for a few reasons. First, the information on the tape is not assembled in an optimal way to compare the recent past with the present. It's just raw data being thrown at you at a high speed. Displaying the data on the DOM allows us to visualize it and keep track of what's happening in real time. Furthermore, Changes in the CME's reporting a number of years back caused the time and sales for popular futures contracts to often be provided as a sequence of very small size orders, usually one contract, as opposed to the true size of the market order that was placed. In contrast, the DOM allows us to see that data aggregated by price, so that we can get an accurate picture of the current state of the market. While solutions such as the reconstructed tape do exist, we feel that they are better used as supplements to the DOM, rather than a replacement. Now the current price of the asset is $100, which reflects the most recent transaction made. This is the price you will see on your chart or quote board. However, do note that the last traded price can differ from the current best bid and offer if new limit orders are placed and/or existing ones are canceled. Trader 1's updated limit order to sell 5 contracts is next in line to be executed at the price of $100, followed by Trader 2's original limit order for 10 contracts. Now, an aggressive seller enters the market. He places a market buy order to sell 3 contracts. The first contract will be matched with Trader 4's limit order to buy 1 contract at 99. Then, the best bid comes at 98. The second 2 contracts are matched with Trader 5's order at 98. Trader 5's buy limit order is now updated to be for 2 contracts. So the aggressive seller sold his contracts at an average price of $98.33 and caused the best bid to be lowered from 99 to 98. This phenomenon is exactly how aggressive participants can move the price of an asset. We also refer to this as the market impact of the order. Note that even though the aggressive seller sold fewer contracts than the aggressive buyer, the aggressive seller was the one who managed to move the price. Why? This is because sellers were more aggressive than buyers. By the way, these imbalances can be important to take into account and could help inform how we want to proceed. Remember, this idea in particular is quite important, and we'll unpack it in a future video. However, one thing I'd like to point out is that while the aggressive seller managed to move the price down, the total number of contracts bought and sold was equal. Again, the total number of contracts bought and sold was equal. That fact is why I don't like it when folks use terminology like, there's more sellers than buyers. That's not true. For every seller, there has to be 1 or more buyers to fulfill the order, and vice versa. Instead, the more accurate description would be that sellers were more aggressive than buyers. Going back to our understanding of liquidity, you can see here that limit orders are acting as barriers to price movement because of the way they are matched with market orders. Lots of limit orders results in a thick book and lower volatility. Fewer limit orders results in a thin book and more volatility, as a smaller volume of market orders is needed to move price. At this point, the spread in the market has also increased. The best bid is 98 and the best offer is still 100. So what would happen if an aggressive buyer entered the market? Let's say another aggressive buyer enters the market and places a market buy order for 5 contracts. This order would be matched with the remainder of Trader 1's limit order to sell 5 contracts at a price of 100. This buyer would have seen price at $98 when he placed the order, but he was filled at a price of $100. Because he placed a market order, he had to cross the spread and experienced what we call slippage. Note that the larger the size of the market order, the more likely you are to experience slippage. We can extend this idea to trading strategies. Let's take another quick detour to explore this principle. You might hear us talk about the capacity of a trading strategy, or the amount of money that a strategy can use before the amount of slippage significantly degrades or even eliminates the profitability of the strategy. In fact, this concept is quite pervasive in capital markets. Many hedge funds set limits on the amount of money they raise, because with more capital to deploy, the number of strategies that have enough capacity to still function correctly decreases. SoftBank's venture capital arm ran into this problem after raising over $100 billion. That money had to be invested somewhere, and when it was, it drove up the share prices of many companies quite a bit. After that liquidity was exhausted, valuations came back down to earth, and they lost a significant amount of money. WeWork was the poster child for this phenomenon. As retail traders, we believe the best opportunities exist in strategies that have too low a capacity for larger institutions to take advantage of. While these firms might be better equipped with an experienced team, advantageous access to information, and superior infrastructure, they are less likely to expend time and effort to employ a strategy that may only have capacity for millions of dollars when they have billions to deploy. But for us, millions of dollars sounds perfectly fine. You might say, why wouldn't they still take advantage of easily available money? The honest answer is that it might be available, but it's not easily available. The large institution still has lots of overhead when it comes to paying for their research, data, and of course, their very well compensated staff. They then have to build a strategy, test it, deploy it, monitor it, and so on. Instead, they want their team spending their time in the most optimal places where they get the best return on their time and their dollar. That's not to say there's lots of small capacity strategies sitting on a bookshelf ready to be implemented. Finding edge in the market still takes a lot of skill and effort. But, as little fish, we might be better served swimming in the pond rather than the shark-infested ocean. Now going back to our example, we can see that the current price of the asset is now $100. In the meantime, many more limit sell orders were placed at various prices above the best offer. Now this aggressive buyer decides he wants to buy more. He places a large market buy order for 35 contracts. This order is matched against the existing limit orders and gets executed against prices of 100, 101, 102, 103, 104, and 105. This buyer cleared several limit orders from the book and moved price by $5. Or in other words, he took a lot of liquidity and had a large market impact. The current price of the asset is now $105. However, remember that the number of contracts bought and sold are still equal. Yet, the aggressive buyer was able to move price from 98 to 105 because buyers were more aggressive than sellers. This auction mechanism is also known as price discovery. The great thing about the DOM is that it allows us to see the price discovery process as it happens in real time. From watching it unfold, we can observe various nuances and subtleties that can help confirm or deny our pre-existing hypotheses, and also help us form new ones. Mock DOM and take a look at a real one. This DOM recording is of the E-mini S&P 500 futures on the afternoon of May 9th, 2024. The configuration is exactly the same as our mock DOM. We have price, bid size, bid volume, ask volume, and ask size. On the far left, we also have the total volume traded at that price. This feature is nice to have so that you do not need to look back and forth between the volume profile and the DOM while trading. Some of us also like to have separate volume histograms for bid volume and ask volume as well. You can see that the current price, or most recent executed order, is highlighted at $52.35 and 50 cents. The highlighted values also show that is where the best offer is, and it seems that one contract was just traded there. The best bid is one tick lower at $52.35 and 25 cents, and 39 contracts were most recently traded there. The bid and ask sizes at those prices are 90 and 67 respectively, though as we discussed before, we won't be paying much attention to these columns. Couple of things to note. First, see how the bid and ask size columns are constantly changing much more rapidly than the middle two columns? This observation aligns with our assertion earlier that there is not much value to be derived from looking at resting orders, since they can, and often are, pulled or updated in advance of that price being traded. In contrast, the bid and ask volume columns tell us more about the trades that were actually taken, and we feel that that information tells us more about the behaviors and intentions of the current market participants. Now in this instance, see how price moved up from $52.35 and 50 cents to $52.35 and 75 cents. Because an aggressive buyer, or buyers, bought 75 contracts, clearing out the existing limit sell orders at the price of $52.35 and 50 cents, and pushing the best offer up to $52.35 and 75 cents, where 10 of those 75 contracts were filled. I'm now going to skip ahead so that we can watch some more interesting action. An aggressive seller stepped into the market and placed many market sell orders in succession that moved the price down by about 4 ticks. You can see the heavier volume done on the bid from the red numbers in the ask volume column. Also note how when this participant entered, the speed of the DOM picked up relative to what we had seen previously. These relative changes in volume and pace are really important to flag when reading the DOM. So let's keep going. Notice what just happened. An aggressive seller was pushing price downward, but eventually ran into a wall of limit buy orders at 52.34. You can see that 175 contracts were traded there. In conjunction, an aggressive buyer also stepped into the market, buying 284 contracts at 52.34 and 25 cents. While it's impossible to say for sure, in practice, you will often see these larger limit buy and market buy orders pair together when a very aggressive buyer wants to take a position without encountering a lot of slippage and making a large market impact. Typically, this type of buyer will first put a stop to the aggressive seller by providing enough limit buy orders to match his market sell orders, so that price ceases to fall. Then, once the seller has no more contracts left to sell, the buyer begins to fill the rest of his order at market, pushing the price higher. Note how now the price is nearly back to where we started, and no additional trade was done below 52.34. In very simple terms, if price is not able to go lower and there is a bit of upward momentum, it is not far-fetched to anticipate that the price discovery process will continue at higher prices. These are slow and very small-scale versions of some of the concepts we plan to cover in depth in future lessons. While in this example, we were only looking at a handful of ticks, the same ideas apply when examining larger market moves intraday. That's all for this one, folks. While some of this material might seem basic, we actually covered a lot of ground, including many of the key principles that we will leverage for our more advanced concepts. Watch this video multiple times and really internalize these ideas. And of course, stay tuned for future lessons, where we'll break down specific sequences on the DOM that resulted in great trades. Take care and see you for the next one.